I'm Charlotte McLeod with investingnews.com, and here today with me is Lobo Tiggre, CEO of independentspeculator.com. Thank you so much for being here. Great to have you.
Always a pleasure, Charlotte.
Really good to be catching up with you. I think we have a lot to talk about, but I thought we could start with your recent news. So you wrote in your latest newsletter that you bought a stock, an oil stock, for the first time in months. So I know you can't name names, but can you talk about what prompted you now to buy?
So let's start with the very basics. The whole idea is buy low, sell high. I sold a bunch high, so sitting on a large pile of cash. I have made money, which is the object of this. So I felt no great hurry to try to instantly deploy right away. The object is to make money. It's not to just blow things out, whatever. So I've been very patient. I've gotten a lot of pushback. Are we there yet? Are we there yet? Are we there yet? And the answer has been no. I want to buy low. And what's happened, and this isn't something original to me, anybody can see it, that the oil prices have done a round trip to pre-war levels. And many of the stocks, even the blue chips, that are just making tons of money, gobs of money, they have done likewise. If they're not quite to pre-war levels, they're objectively way down from where they were. So that makes the oil patch interesting. For the first time since January, there's something that I'm actually interested in buying. Woohoo. Black gold. That said, there was a big ramp up before the war. There was a lot of saber rattling. There was Venezuela. So to make a round trip to pre-war levels doesn't actually mean that we're at a cyclical low by any stretch of the imagination. So the answer to your question is there was one stock that dropped more than others, or more sharply, more unreasonably. It got to what I saw as an oversold condition. And so I acted on that one. I have a whole shopping list for my clients. I did not buy the whole shopping list because, less high is not the same as low. And, oil remains under pressure. As you and I speak today, we just had a couple more attacks in the Strait. Oil is up a bit, not hugely. The Saudis are still loading out. So it's interesting. But the overall, these kinds of blow-ups and dust-ups have been happening throughout. I don't call it a ceasefire. I call it a less fire. And throughout the less fire, we've seen less fire. We've seen more oil come out. There was a big rush at first. And by the way, that big glob of oil that squirted out when the MOU was signed, that'll start hitting the markets pretty soon. So, long story short, oil itself has done a round trip to pre-war levels. That's not a low, but relatively low. Many of the stocks have gone up and gone back down again to interesting levels. There was one that I thought was cheap enough, to constitute buy low. And, if that's all I do this year, believe it or not, I'd be okay with that. The idea is to buy low. And I feel, let me put it this way. People got so mad at me when I talked about selling after January, right? I didn't top tick that. I talked about selling at VRIC in January, and then I executed on the following dead cat bounce after the big drawdown. And since then, gold's dropped $1,000, $1,500, and sitting on a pile of cash, one doesn't feel quite so anxious about gold dropping. One wonders, when are we there yet? Am I going to start buying again? So that's where I'm at. I've made money for myself and my clients. I have no interest in trying to race to do something now. I'm looking for opportunities to buy low. One more caveat. You've been patient with this long-winded answer, but this is where I'm at today, is that I bought one that I thought was oversold, not the rest of the shopping list. I think oil probably goes lower. Both Rick, we're here at the Rural Symposium, and my friend Adrian Day, both of them said that even if oil goes sideways or carves out a bottom here, the stocks could easily go lower because market sentiment. Mr. Market only likes it when prices are going up. If they're not going up, it's bad, right? Even if at these prices, the companies are making money. So I think that I'll probably see lower prices ahead, and that makes it difficult for me to rush out to buy everything. But here's the thing I want to make sure the audience is clear on. If you're in that camp, you've been listening to Jeff Curry or Eric Nuttall or one of these people, these oil experts who are saying the bottom's in, the reality is going to hit, right? All that shut-in production's not coming back. The Strait's only quasi-semi reopened. All that stuff, I get it. and if you're convinced, if you are convinced, you're sure the bottom is in, and oil's probably going to stagger upwards from here, then I wouldn't wait. I would actually go ahead and buy that whole shopping list like today, if that's what I thought. It's not what I think. I can't quite shake the feeling that I'm going to get a shot at lower prices. So I'm being patient with that. But I want to put that out there for the audience, because anybody says, oh, no, you're wrong. Well, if you're sure of that, you know what to do.
I think that covered all of my follow-up questions on the note of oil. So we know why you only bought one. We know what it would take for you to start picking up more on the oil shopping list. Maybe we can talk just briefly a little bit more about your outlook for oil and why you do think those lower prices are a possibility, despite others predicting, no, this is the bottom.
Right. So, my overall thesis is bullish. I wouldn't be buying them if I thought, Doomberg's right, it's all going down forever. That's not quite what he said. Sorry, but I went there, so let me say, Doomberg's thesis, I think Doomberg is actually probably right as well, but his is a long-term thesis. And I'm a speculator. My investment time frame is a year or two. And Doomberg he's laid out a 50-year vision of the future, which will have ups and downs along the way. And other people are in that same boat. So my view is bullish, not necessarily forever, but as a consequence of this war, as we've got, the damage, how many countries were really honest about how much infrastructure and damage they suffered in the Gulf? Some places made it illegal to take pictures of missile strikes and things like that. I don't think any of them were honest. We really don't know what the damage is, but we're about to find out. I think that's bullish for oil prices. It's also, abundantly evident that Iran really wants to have its toll booth there, the Ayatollah booth, right? Whether they're allowed to or not, that's going to be either a bone of contention or it's going to be extra cost. And the Omanis are getting in on it. They're like, oh, we like that idea too. We could get together, and it's not a toll, it's not a fee to get through. We're just charging you for our services to help you transit safely, right? Whatever you call it, it's an additional cost for that, and that's not a good thing. And then you've got the strategic political reserves. I almost said petroleum reserves, but the strategic political reserves, which have been drained everywhere. The U.S. is still draining its own as of last note. But at some point, those need to be refilled. So that's a huge amount of demand. Think about it. The draining was enough to keep oil prices down despite the bloody Strait of Hormuz being closed. So what happens when that goes into reverse? That's extremely bullish. And then I think there's, even beyond that, the refilling, I think there's going to be new SPRs out there. If you were Australia and got caught short, or Sri Lanka even, rich country, poor country, any country that suddenly didn't have enough, is going to be saying, holy cow, we really can't afford to be caught out like this again. And who knows what might happen in the Middle East. Maybe this MOU, this less fire, goes up in flames. I don't think Netanyahu's particularly pleased with the status quo and the way things are. The job's not done in his mind. So I think that we'll not only see SPR refilling, I think we're going to see new SPRs. That's bullish. And remember the COVID lockdowns and less travel, all that stuff, then there was revenge travel. So if the coast really is declared clear, the strait's really wide open, I think you'll see, SPR refilling. I think you'll see people who maybe delayed holidays or whatever because they were worried about higher oil prices or whatever. I think, for multiple reasons, there's a lot of pressure there. And people talk about demand destruction in this place. Sorry, I'm going on a bit, but that would be the counter argument. What about the demand destruction? I just think that's an incorrect word. If prices are high and you spend less now because you can't afford it, it's not that your demand has gone away, it's your capacity to pay that much has gone away. And as soon as the prices come down again, well, hey, that demand is still there. Well, now I can afford it, so I'm going to take that trip to go see Grandma or Disney World or whatever. So, if you're in a poor country where they really got clobbered and, there's people, taxi drivers as an example, just like parking their car because they, well, once the fuel is affordable again, you're not going to not work. You're going to turn on the car and get back to work. So I think of it more as demand delay rather than destruction. So, ultimately, very longer term, oil, I think, does get more and more replaced. My view for many years actually has been there will be a time in the future where we just don't burn oil for energy. It's too valuable for other uses, plastics and fertilizers and other things. And so just burning is kind of a waste of this valuable resource. And we don't need to with the technologies moving in the direction that they are. But that's many years in the future. Again, my investment time frame is the next year or two. I think the reality coming to the marketplace soon is going to drive oil prices higher. But in the near term, woohoo, the war is over, everybody's going to live happily ever after, sing kumbaya, all that stuff. And that spurt of oil that left us straight on top of the elevated production in North America, I do see a recipe for lower prices in the near term. And even if it just carves out that bottom, goes flat for a while, I think both Rick here at the symposium and my friend Adrian Day have said that, if oil just goes flat for a while, the stocks will probably still drop lower. So all of this makes me highly desirous to add more oil to my portfolio, oil and gas, but oil in particular to my portfolio. But it doesn't make me in a rush to buy today. And so I'm holding out for what looks like objective opportunities, objectively low opportunities to buy. And if I get it, I'll make more money. If I don't, I may miss out on an opportunity that's on the table today, but that's okay. There's always another girl to ask out to dance, or guy, or whatever.
Well, very good look at the short and the long term for oil. And I want to pull out another point from your recent newsletter. You talked about how investor attention is shifting from the Iran war to the Fed. I think that's definitely true. And maybe it's premature to cast that conflict aside, but I do think it's worth talking about the Fed. We have a new Fed chair since the last time we spoke. Anything you would pull out from Warsh's first press conference after the meeting? Because he made quite a number, I think, of interesting statements.
Yeah, there's been a lot of ink spilled on that. So a couple things. Well, one is I'm a due diligence guy, not an economist, so grain of salt, all that. Two, today as we speak, the war has head up a little bit and has people a little bit concerned. But overall, over the last month, especially since the MOU, it has been very evident to me in the daily, intraday, and weekly market action that investors have shifted back. Like, okay, the markets clearly think the war is, if not entirely over, it's over-ish, and it's going to be completely over soon. That's the way the markets are pricing things, in my view. That's what the data tells me. And so now that, well, if that's what you're thinking, well, then you pivot back to the Fed. And we have seen in recent times the kinds of headlines that trigger the algos and the humans to predict, okay, Fed reaction will be this, therefore sell that or buy this. And we've seen that with gold in particular, but other things. It seems abundantly clear from the evidence to me that Mr. Market has made this pivot. Now, here's potentially the source of opportunity, and I can't give you a stock pick or marching orders exactly. But aside from the fact that the war may flare up again, let's set that aside because that's not a calculable risk. It either does or it doesn't happen. We'll see. But let's say that the war is largely over and going to continue to be over, at least to the midterms. So where does that leave us? Well, it leaves us back to Fed whispering and, looking at the oracle's tea leaves and, what did he say? What did it mean? And all that. And here's the potential source of opportunity. The markets have decided that Warsh really is independent, despite him doing basically the same thing Powell did in his last meeting. Like, in terms of what the Fed actually did, there was literally no change from Powell's last meeting to Warsh's first meeting in terms of actions taken. In terms of rhetoric, complete difference. And people are like, oh yeah, well, so he's so independent. I'm really impressed. He's not just kowtowing to Trump. He sounds, he talked this really hawkish talk, and we're talking maybe rate hikes and whatever. But lips moving. Of course, he sounded hawkish. Of course, in his first press conference, he wanted to come out as independent. And remember that the Fed heads, the members of the Federal Open Market Committee are well aware that their jawbones are policy tools. It is part of their tool chest. So of course he wanted to set the stage in a positive way, not only to protect Fed credibility, to say, you know, I'm not just a yes man for Trump, you know, that was positive. And sounding hawkish, sounding very hawkish, allows him to actually ease without easing. Like if the inflation information remains going the wrong way, which it is, if that keeps happening, and he really should raise rates, but he really doesn't want to because he does have a deal with Trump to be easy, then having sounded hawkish, doing nothing, just holding flat, psychologically on the market has an impact like a cut. Oh, we thought he was going to raise rates and he didn't. Whew, oh, big sigh of relief. So again, just doing nothing comes across as easy policy. So it all seems to me, you know, to quote Doomberg again, he has a good word. He calls it performative. These things are like performances. You have to understand that their actions and their words are deliberate. So the opportunity I'm saying is the markets are taking this like the gospel, or, you know, these 15 commandments, 10 commandments, right, written in stone, you know, Warsh is hawkish. And I'm saying not so fast. And if that's wrong, if that's a misinterpretation or an overinterpretation of rhetoric, you know, tuck that away in your mind, because markets won't do what they're expecting now, and repricings should open opportunities in different ways. And by the way, so for us as gold bugs, this is very important to monetary metals, because that new fear of hawkishness from the Fed, if it's wrong, that's actually pretty bullish for gold and silver.
Exactly. I don't want to go too deep on a Fed path here, but you talked about Fed whispering. Everybody likes to follow so closely what's being said or not said. And in that press conference, Warsh, I think he hinted about, well, maybe I do less of these. Maybe it's a little quieter from the Fed. So how do you see that panning out? How do we do our Fed whispering if there's nothing to whisper about?
Well, that was actually one of the things I liked about what he said. You know, he said the Fed should follow the markets, not the other way around. Which is, I agree, you should. Or as Jeff Gundlach's been saying for years, like just get rid of the Fed and just use the 2-year. That's what the Fed does anyway. With some small variations, they follow the 2-year. So just substitute the FOMC for the 2-year and you're done. Much cheaper. So for Warsh to say that, you know, it sounds good. It sounds rational. And it is kind of ridiculous when you see the markets going with wild swings because they changed happy for glad in the FOMC statement. So in making that go away, I can see advantages to it. The disadvantage, of course, is when you do get policy shifts, they could be more surprising, and then you could have, you know, more, even bigger, more outsized reactions. But either way, I would say that the idea of that is positive. But let's see if he walks the talk. Like, he's saying that, but let's see what actually happens. And, you know, he may decide to just answer. There's a task force for that, for every question that he's asked. And anybody who watched that, they know what I'm talking about. But the other guys and gals in the Fed, you know, there's no gag order. They could, you know, offer guidance and things. So we'll see. You know, if the dot plot went away, I think that would be fine. I don't think it was very helpful anyway. And yeah, much more than that. Again, I'm not really a Fed whisperer. I'm not sure that I've ever gotten their calls really right. But I do think it's interesting. It would be great if Warsh actually walked the talk. Or great, less bad, much less bad, I think. But I'm not holding my breath. I think, I don't know how exactly he got that job, but he didn't get that job to be hawkish. Trump would never have nominated him, and whatever conversations they had behind closed doors, I can't believe that he's there just to do whatever the right thing is for the economy. Otherwise, there was no reason to get rid of Powell. I mean, from the mainstream perspective, I would get rid of the Fed entirely. But if I'm a Washington insider, there was no reason to get rid of Powell if that was the goal.
Yeah, I see what you mean there. While we're on this topic, we've been talking about the possibility of a recession in the U.S. for some time. And it feels like the warning signs keep continuing to build. So, what is your current economic outlook? Why haven't we seen this downturn yet?
Well, I've kind of taken a vow of silence when
Oh,
it comes to
no.
recession calls. Because to be fair here, I mean, I got some things right. When in January, my call about taking profits, literally 2 days before the top, I did not call the top. But I've done some things right, and people are accusing me of being a guru and saying that my crystal ball works better than I'm letting on, but it doesn't. And I think I said multiple times on this show with you in 24 that we would have undeniable recession by the end of 24. And we arguably, we had 2 quarters in 22, was it? And then we had the so-called rolling recession throughout. I could try to weasel my way out of that, but I said undeniable recession by the end of 24, and there was certainly plenty of denial, if nothing else, right? So I'm cautious about making recession calls. But you were very nice and didn't actually ask me if we're going to have a recession. You said, what's the holdup here?
Yeah,
So
why not?
part of the answer is, Charlotte, for years it has looked like the economy deserved to go into recession as shorthand. Nobody deserves that, but like so many policy errors. But the money printing seems to have won out. There's so much money flooding out there. It was really astounding to see, not just in the wake of the lockdowns, but even during the lockdowns in the COVID period, to see the stocks soaring like that. And all that money printing had to go somewhere. And guess what? The money printing never stopped. In fact, what I got wrong was I thought that as things not normalized, but we came down off the COVID cliff and things were less scary, I thought they'd pull back on the money printing, and we try to have some semblance of economic sanity. But the money helicopters never stopped flying. All that money kept going, and a lot of it went into stocks and anything. So my view now is it's extremely dangerous to say that even though there's all these scary signs out there that the economy should go into recession, we had wartime levels of deficit spending before the war. And now Trump wants a 50% increase in the U.S. military budget. Plus, we've got, we cut taxes, but we didn't cut spending. Doge failed, sorry, right? All those trillions of dollars Elon was going to save, it's arguable how much of the 150 billion or whatever it is actually got saved. And I say that with a tear in my eye. I would have loved to have seen actual budget cuts in Washington, but no. So all that money's still being spent, and a lot of it's, there's this talk about the K-shaped economy, and I think there is a lot of truth to that. But a lot of that money is going to the bottom part of the K as well, the subsidies, the supports, the help. People aren't happy, and we see that in consumer sentiment things, but they're not starving. I think here at the Rural Symposium, like I think Rick likes to say, if the price of oil goes up in Sri Lanka, it's a big problem for people. If the price of oil goes up here or in Texas, people grumble, they gripe, but they fill up their tank and go to work anyway. So, long story short, it seems like at some point reality ought to hit, and there has to be a time when we pay the piper. But right now, I see no reason to expect the piper to show up this year.
Okay.
How's that for a forward-looking statement?
Yep, that's the stance for 2026. I'm sure we'll review it at some point later. I also want to check in on where you're at with gold and silver. So we've seen pullbacks from the last time we talked and from the beginning of the year. And at this event, I'm hearing a lot of people say this looks like a buying opportunity. But it sounds like we talked about the one stock that you've recently bought, which was an oil stock. So what is your stance on, would you buy back into gold and silver, or are you happy that you ran that wave at the beginning of the year? How are you feeling?
No, yes, and great. When gold drops $1,500 and you're sitting on a pile of cash, profits realized, not on paper, realized. It's much easier to watch those price retreats. So I think much of our audiences knows my thinking. My base case has not changed. I expect consolidation, correction period, and then the next big move to be upwards. But even if that's true in a relatively benign outlook, there's no rush to buy. There's no reason to think that this dip is the biggest one. We had as much as a 20% correction during that period from 2020 to 23 that gold, zoomed up over 2,000, corrects and consolidates for 3 years, and then off to the races. A 20% pull down from January's high is over $3,000 lower. That's a big move. So, and if that happens, what happens to the gold stocks? So even if we are in this period of correction and consolidation, I feel no FOMO right now, no sense of urgency to deploy. There is nothing that tells me for sure or even highly probable that the bottom is in. It could easily continue waffling sideways around where we are now for another year or two. It did before. And there's also the chance that January 2026 was like September of 2011, or worse, January of 1980. This is not my base case. I am not calling a market top here. I'm just saying it's possible. And if you superimpose the charts for those peaks, it's scary how similar they look. So while that remains a possibility, it certainly doesn't make me feel any sense of urgency to reach out and try to grab that falling knife. So I'm watching that closely. Maybe the more useful answer here is where I'm at right now is I'm not buying anything, gold and silver stocks. And by the way, this is stocks. I didn't sell an ounce of my gold or silver bullion, right? Those are accumulate ideas for me. So with the stocks, I'm not buying anything, gold and silver. If the markets continue to correct, if we go lower from here, and I know silver's corrected a lot, but silver's always more volatile. If gold goes lower from here, it starts to look a lot more like 1980. And that makes me want to be very patient. If we continue to consolidate sideways here, I actually feel much better. 1980 is probably off the table. And we're looking, at more of a shoulder here. And then I might start looking to see if there are any compelling value propositions out there. But that needs to hold up for a while for me to push the 1980 scary scenario off the table. One more quick thing. If that does happen, the interim peaks on the way up, we've seen 50% drawdowns in gold after those peaks. So I don't know how to time the market. I'm not smart enough for that. But I do know that the troughs, the previous troughs, were about a 50% drawdown. So if we get a 50% drawdown from January, which would be sub $3,000 gold, I just realized I made a mistake in my math earlier in my 20% waffle before. So sorry, folks, that was wrong. A 50% drawdown from gold from its January high would be sub $3,000. And at that point, if that happened, I'm not predicting that, promising that. I'm just saying if it got that cheap, history tells me that's about as low as it goes. At that point, I'd just start buying. I'd have a garage sale, sell some blood, whatever. That would be cheap enough. And by the way, if it did that, the stocks would fall off a cliff. Even the best of the best that make money at those levels, those babies would get thrown out with the bathwater, and I would be there with a big net to catch them.
All right, so gold and silver could go lower, will likely continue to go sideways for some period of time. Is it too soon to pinpoint a factor that breaks them out of that sideways trend at this point?
Yeah. I mean, if they started rallying again, if we got actually to a new nominal high, if it returned to 5,600, 55 and change gold over the year ahead, that would be completely different from 1980 or 2011. That would break that pattern. And I wouldn't want to buy high and hope to sell higher, but that would actually allay my fears substantially. And probably at that point, to be honest, if that happened, if let's say the bottom is in and gold and silver go up from here, and by the end of this year, gold has gone over 5,600, I will not benefit from that on stocks. I'm not going to buy because that might happen. But the answer to the question is, if that happens, then that completely breaks with the past. Then the comparisons go away. I'm not worried about that anymore. And probably if that happens, there will be reasons on the macro, geopolitical or other reasons. And we would know we were in a different phase of the market.
All right, I know I have to start wrapping it up and sending you back out onto the show floor, but before I let you go, any final thoughts? Maybe we sum up what the shopping list is looking like, if there's anything beyond those remaining oil stocks.
So right now, the shopping list is entirely oil stocks, because I do think we're likely to get a lower entry points. I've already dipped my toe in, right? I've
Yep.
already started buying. Those are my marching orders right now. The idea is buy low, sell high. And of all the things that I like, gold, silver, copper, uranium, oil is the only one that comes close right now to a buy low-ish opportunity. And I'm hoping to have an actual buy low opportunity. What I like to say is right now we have an advantageous situation in that if that's wrong, let's say the war does heat up, like there have been Iranian strikes as you and I speak, new ones. The U.S. has not responded yet. Let's say that response is pretty big, and it prompts an even bigger one from the Iranians, and it's off to the conflagration again. Oil goes way up again. My little toe dipping works out, but I don't get filled on my shopping list. But that probably is bad for Dr. Copper. So that's one of my other favorite commodities we haven't talked about yet. So I see this as like, I either get my opportunity to buy more oil stocks, or I'll probably get my opportunity to buy copper stocks. So I like that a lot. And it's really neat. I mean, one or the other has to happen. Either the war heats up again or it doesn't. So that is another thing that makes me patient. And then just real quick, I mentioned copper. I do like copper. Long-term, very bullish thesis. If this war thing doesn't put it on sale, then maybe the AI bubble blowing up does. So again, these possibilities of chances to buy low make me in no rush to chase them right now. And one more thing we really haven't touched on yet would be uranium. I see it as similar to copper. But if anything, I see more near-term oomph in uranium because the spot price has been below the long-term contract price. And that might sound a bit technical, but not really. I mean, it's just the real market has been ratcheting up all year, what the actual buyers and sellers are trading at. And the spot market has lagged it since January. And those two lines never stay apart for long. So I see a snapback or upwards in the spot uranium, likely to move uranium stocks when it does, which makes me pretty interested in uranium stocks as well. Can't really call it a buy low opportunity, but if, say, that AI bubble popped and put them on sale, I would love to buy more uranium stocks. And I said, like right now, this one oil stock's the only thing I bought, but if I didn't have any uranium in my portfolio, which is chock full of uranium right now, but if I didn't, this potential, the long-term bull thesis plus spot being under the real price, I would buy this week. I would, buy whatever dip presents itself this week, and I would add some uranium in my portfolio right now.
All right, well, different options for different people. And I do remember copper is the top pick for 2026. So next time, I'll make sure we go in more of a copper and uranium direction. But
Okay.
for now, thank you so much for coming on to go over oil and gold. I think this was great. Thank you.
Black gold and regular gold.
Yes,
Good
there you
topic.
go. Much better way to say it. All right, well, once again, I'm Charlotte McLeod with investingnews.com. And this is Lobo Tiggre with independentspeculator.com.